Hey guys, thank you guys for tuning in today to hear me and Paul, mostly Paul, speak. We're going to be talking about being a boring investor, and then we're going to switch it up to self-storage. But before that, we'll make sure we'll do Q&As on the boring investor part, but then also we're going to be switching it up. Paul Moore just wrote a really unbelievable book. It's a Bigger Pockets publication book. We're going to be talking about...
Unbelievably boring.
No, I thought it was an
Okay. I just want
excellent
to be
book.
sure.
And it's not just about self-storage.
Okay.
I went through it, and there was a couple of chapters in there that honestly you could take those out and apply it as, golden principles to investing. I think we talked about one of them was the difference between investing and speculating. And I always, every time I go to a friend's barbecue or people that are not in the investment circles, it's amazing how many times that they come up to you and they're talking about speculating. Right? They're talking about these huge gains and they get blinded by these tremendous returns and, the Bitcoin craze and everything like that, even though I'm not a crypto guy, but they'll be like, oh, I hear everybody's making 3,000%. And they don't realize what they're really talking about is speculating. So I really love that chapter where you talk about the difference between speculating and investing. That's going to be probably one of my Q&As later on. But I highly recommend that book for everybody. It is on Amazon. We're going to talk about it later on, but highly recommend it for everybody. The other thing I want to mention about Paul is when I was starting my fund, I was introduced to Paul by a mentor of mine. And I remember the idea, and there was no reason for Paul to be supportive or actually any reason whatsoever, because I was relatively new to the industry. I just remember that conversation. I was in a hotel room at that time, coming back from a due diligence trip. And my partner actually on the 50 unit deal was actually in my hotel room at that time. And I got on the phone with Paul, and it was literally 2 hours of nonstop support and just encouragement. And I got off the phone, and it wasn't even like I was on the fence because I was already, creating my website for my fund and everything like that. But just hearing Paul and his words of encouragement was, a highlight of my career, my young career. The last thing I want to mention by Paul before I hand it over to Paul is a few years back from being introduced, I went to the Mid-Atlantic Conference. Paul did not have one of the big main entrance speaker slots. He was in a side room, but he had a very loyal group that came out, and the room was absolutely packed out. And I remember Paul came up to the podium, and he didn't start it like everybody else. And I think I heard 20 different presenters at that time. Everybody that just gets in, they talk about assets under management, how they own, $100 million worth of properties. And they go into these, I guess, this very dry start to these presentations, but Paul really treated it as a presentation. It wasn't just about the business end. And I asked permission for Paul for me to repeat how he actually started that presentation. And then he actually sent it to me, so I can't actually misphrase it. So I'm just going to read it. And I think it'll highlight what kind of guy Paul really is. So this is how Paul started the Mid-Atlantic Conference. So several men are in the locker room of a golf club. A cell phone on a bench rings, and a man engages the hands-free speaker function and begins to talk. Everyone else in the room stops to listen. Hello? Hi, honey, it's me. Are you at the club? Yes. I'm at the mall now and found this beautiful leather coat. It's only $1,000. Is it okay if I buy it? Sure, go ahead, if you like it that much. I also stopped by the Mercedes dealership and saw the new 2021 models. I saw one I really liked. How much? 85,000. Okay, but for that price, I want it with all the options. Great. Oh, and one more thing. The house we wanted last year is back on the market. They're asking 950,000. Well, then go ahead and make an offer, but just offer 900,000. They'll probably take it. Okay, I'll see you later. I love you. Bye. I love you too. The man hangs up. The other men in the locker room look on in astonishment. Then he smiles and asks, I wonder whose phone this is. And I think in the world of passive investments, I think in the world of alternative investments where you really rely on your network, sometimes the person on the other end of the phone call, when you're talking about operators and syndicators and investments, they really sound like the husband in this script, where they really know what you're talking about. So this scenario always rings true to me, that, whatever you listen to, you have to listen to with a little bit of skepticism of who's on the other actual, who is actually answering that phone, and what are their motives. So that's kind of what I wanted to introduce. I thought it was such a creative way to start a presentation, and I've remembered it for the last 4 years since I've actually heard it. So Paul, given that, I'll actually turn it over to you, and then I'll jump in once in a while.
Fantastic. Jump in anytime, Dennis. So, man, it's a real honor to be here, and especially with your group here. So I'm glad everybody signed up. And for those listening later, looking forward to connecting with all of you. But, why in the world did you come out to hear something that's so boring? How to be a boring investor? Most of us don't want to be boring, but I am going to make the pitch that speculating is more exciting than investing. But investing, usually for most people over the long haul, is more profitable. Before we jump in, I'll just tell you a little bit more about me. I've been married almost 35 years in Lynchburg, Virginia. Sold my company in 97 at 33, tried retiring and got so bored that I started investing or speculating in real estate to protect and grow my own wealth. Wellings Capital grew out of a lot of good and bad investments over the years. We're a real estate private equity firm, and we try to assist others as they protect and grow their wealth. We're not an operator. We are a due diligence partner to our investors. Our goal is to find the very, very best operators we can in commercial real estate, put them together in a diversified fund, and then through that diversification, bring a variety of asset types, geographies, operators, strategies, and of course, properties. So our goal is to get better terms and better returns that investors would typically find on their own. We've got almost 500 accredited investors, and we have invested over $70 million. I actually started out in commercial real estate in multifamily, and I ended up writing this book 5 years later called The Perfect Investment. But it's about apartments, and guys and gals, let's face it, the perfect investment's not perfect if you have to overpay for it. So 6 years later, I found myself writing a book on self-storage called Storing Up Profits. It just came out from Bigger Pockets Publishing about 2 months ago. But we're going to talk about the joy of being a boring investor first tonight. I really do believe this. When I started out, I wanted to be an exciting investor. I wanted the same thrill out of investing that I got out of being an entrepreneur. And that was a big thrill. Even though we lost money on some deals and made money on other deals, it was fun. The thrill of the chase was there. But I found out over the years that there's probably a better path. Entrepreneurial investors is what I call people who want the same thrill out of their investments that they get out of their entrepreneurial activities. But it can work. I mean, every great invention started out as a speculation, right? But most of them didn't get anywhere, and that's the problem. Entrepreneurial investors, like I was for a decade, love the thrill of the chase. They stay in startup mode. They're always doing that, that takeoff where they're always telling their families, we're almost there, right around the corner. At least I did. They get a rush out of the process. We repeat the learning curve over and over, get a broad but not deep knowledge about lots of different topics, may hit a grand slam or may strike out. And as Denis mentioned, they speculate before investing when it should be the reverse, I think, for most. Entrepreneurial investors might retire in a mansion, or they might end up working at Walmart after retirement. It's just not what I want to do anymore. So I think a lot of people can relate to this. So today I'm going to go over several aspects of being a boring investor. So the first one is boring investors attain true wealth. Warren Buffett said, if you don't learn to make money while you sleep, you'll have to work until you die. How do you make money while you sleep? Well, you attain true wealth. True wealth, I would define as assets which throw off cash flow. Assets that throw off cash flow, it might not be a mansion or a Mercedes or a Tesla or whatever, you would look at as signs of true wealth, but they are assets that throw off cash flow. And Robert Kiyosaki, if you remember his famous cash flow quadrant, they're typically assets in the lower right quadrant, where basically you're not working, you're not putting sweat and hours in to get this wealth and to get this cash flow. You actually have assets that produce cash flow. Next, boring investors enjoy real freedom. William Green wrote a new book that I am in the middle of right now. It's called Richer, Wiser, Happier. And Charlie Munger called it one of the greatest investing books of all time. He marvels that all these billionaires, actually, they continue to grow public funds, and they continue to put unending pressure, criticism, and legal battles on themselves. And they don't really get the freedom that they lived all their life to get. But I would postulate that we were put on this earth for more, that true wealth brings freedom, and freedom gives us a chance to invest in our lives, our families, our hobbies, our community, in fighting human trafficking, which I'm going to try to talk about later if we have time. True wealth and boring investing brings the freedom from trading hours for dollars, the freedom of not worrying about the next GameStop deal or the Bitcoin rally, freedom from toilets, tenants, and trash, freedom to use your time and money to make a difference in the world, and freedom from agonizing over every spending decision. Boring investors also avoid hidden costs. Now, my friend Kevin is a great example of this. Kevin is an investor with my company, Wellings Capital, and he and I talk often. In fact, we're talking tomorrow. And he talked about the hidden costs of speculating. He said that he actually had these stock options in his company, and he was working this full-time job. He actually made a lot of money in tech, but he was working this great job, but he was spending all his free moments. I mean, like lunch, evenings, weekends, middle of the night. I mean, constantly checking the stock price and worrying about it. And he said this worry took a toll on his health. It took tremendous amount of time away from his family. It took time away from his job, so he didn't perform as well. And it ultimately cost him in every way. And he didn't make one penny more. In fact, when he got active in trading those things, he actually made less than if he would have just relaxed. And now Kevin invests widely in real estate, and he also invests his stocks, because he's got these stocks he has to have in his 401k. He invests in, ETFs. He doesn't look at options. He doesn't look at anything like that at all. And he said he's so much happier, and he's avoiding the hidden costs that he had before. Boring investors lose money and make a fortune. Denis knows this. I had a podcast for 4 years called How to Lose Money. And on this podcast, we interviewed 238 successful entrepreneurs, business owners, investors, and they told us, hey, they lost money, but they learned lessons. And rather than just pack it up and quitting real estate, they actually went out and they took those lessons, and they learned those lessons. They took those and they applied those, and now they're making a fortune. And that's what we covered on that show. They learned they had the humility to learn from their mistakes rather than just quit or repeat them. Boring investors invest in boring assets. Now, we're going to talk more about this later, but Denis, how can you get any more boring than value add self-storage? When I first heard about value add self-storage, I think I laughed out loud. I mean, think about it. We're talking about 4 pieces of sheet metal, some rivets, a floor, and a door. And you call that a value add? Where are the Where are the where's the flooring and lighting and fixtures and countertops and cabinets and appliances and bark parks and all those fun things that apartments have? Self-storage looks boring, but actually it's a amazing money-making opportunity and wealth building opportunity. And like I said, we're going to talk about that more this evening. Boring investors invest in the gold rush. Well, sort of. I don't have time to tell you the whole story, but I invested in an oil boom in North Dakota in 2010. And my friends and I sunk about a little over $1 million in total to the bottom of a hole in the ground, hoping to, produce 5 or 10 or even 50 times as much oil. And we got exactly nothing out of it. So it was pure speculation, even though we thought it was a sure thing. Of course we did. Well, after that, we realized there was a huge housing shortage in North Dakota. So we started building housing for these oil workers, and we made a lot of money, over $1 million a year doing that. It's sort of like the gold rush in Alaska and then in San Francisco before that, or in California, I should say, where they actually, the people with hardware stores and dry goods stores and those selling picks and shovels more consistently, more reliably made more money than everybody else. And of course, that gave them what? True freedom. They got the freedom to go to those same mountains in California, the Sierra Nevadas, where gold was being panned, where people were sweating and even dying, and they were actually able to go vacation there because they had true wealth. And I think that's what a lot of us want. Boring investors have a long view. And what that means is Warren Buffett said, someone asked him, "What's your preferred hold time, Mr. Buffett?" He said, "My preferred holding time is forever." It's the opposite of day trading. And it's an opportunity. Basically, it's a thought process that says, look, I want to buy this and I'm going to plan to hold it forever. Buffett talks about making 20 investments your whole life. If this is one of the 20, would you do it or not? And that's the kind of thinking that I want to have from now on. Boring investors don't chase shiny objects. I am a former certified shiny object chaser, and I hate it. And I wish I hadn't. I used to want to put serial entrepreneur on my business card. Huge mistake for me, at least, to live that way. Now, Elon Musk, he can live that way. And we're going to get back to Elon in a few minutes, but there's a price to pay. Like we said, there's a hidden price of chasing shiny objects, and it can be really painful. Paul Samuelson is the first US economist to win the Nobel Peace Prize. And he said that investing should be boring. He said specifically, investing should be like watching paint dry or watching grass grow. If you want excitement, take $800 and go to Las Vegas. Investor extraordinaire George Soros actually said it more clearly. He said, if investing is entertaining, if you're having fun, you're probably not making money. Good investing should be boring. Boring investors choose a lane and stay in it. I wrote an article for Bigger Pockets called, I think it was 3 easy steps to being the wealthiest man in the world. It's kind of silly, huh? Anyway, Bill Gates was the guy I was talking about. And Bill Gates actually did 3 things really well, and they were a path. Number one, he, as a teenager or in his young 20s as well, he decided he wanted to be in tech. He wanted to be in computers. He chose that lane, and you'll see he stayed in it. Because number 2, he actually went and found the biggest, most wealthy and successful company he could find that would partner with him. And number 3, he actually did everything in his power to make them successful, to make IBM successful. And of course, he leapfrogged over anybody at IBM and became the wealthiest guy in the world. It sounds a lot like the go-giver mentality, if any of you have read that amazing book. So boring investors don't keep changing lanes. They choose a lane and stay in it. Boring investors don't get the buzz of grinding harder. My coach keeps telling me, if you doubled your work, if you went from 40 to 80 hours a week or 60 to 120, you won't get twice as much done. You'll be sick and you won't have a family and you won't have true success and you won't get twice as much done. But I'll tell you that when I'm being a boring investor, sometimes I get a little nervous because like I'm not getting that buzz of grinding harder. But that's not where true success is found. It's found in rest and in doing what you're called to do. Boring investors suffer mockery and misunderstanding. If you read Warren Buffett's biography, you will find out that in 1998 and 99, he was getting mocked regularly. Now, this has happened to him several times over the decades, but he was really being mocked in 1999 for missing out on the tech boom. I mean, after all, he was possibly senile, people said, because he was already 69 years old. Kind of a joke for a guy who's 91 now. But at any rate, Buffett was mocked for missing out on the tech boom, and he quietly smiled and he said, you know what? I don't know where technology will be in 10 years. I do know how people will be chewing gum. So I'm investing in Wrigley's. And he did. And of course, 2 years later, that whole tech boom had gone bust, and Buffett's wisdom was proven right. He suffered mockery and misunderstanding along the way, but he succeeded wildly in the end, while many of those people are now forgotten on the ash heap of history. And like Buffett, boring investors sometimes live next door. I think you know what I'm talking about. A lot of people, one of the most successful investors I know drives a Chevy. And a lot of really successful people, they don't flaunt it. They're not out there trying to prove how wealthy they are. One of my favorite boring investors is named Joshua. And I'll tell you, he is the co-founder of Exchange Right. And this is a company that coordinates Delaware statutory trusts for 1031 exchange investors. And he and his partners have given away over $40 million in just the last several years, because he wants to live simply, just live on his means, put a tiny bit aside for his kids, tiny bit as a percentage. And then he wants to invest the rest in doing things to impact society. And I love that. And I hope that you guys see the wonderful opportunity that you have to do that as well. Boring investors also invest in happiness. This little piece of information that I'm probably going to misquote could change your life. Check it out. Globally, a study says, we find that satiation, that means full happiness, comes at about $95,000, at least in the Western Hemisphere. And any more money than that, on average, won't make you any happier. Wait, I asked myself recently, if I'm already making over $95,000 a year, why would I pile some whole new investment thing on? It was specifically a big Airbnb deal that I didn't need to do, but would be incredibly profitable. Why did I need to do that if I'm already as happy as I'm ever going to be? Probably. I do believe there is a way around that, by the way, but I'll get back to that in a second. But boring investors invest in true happiness. And one way to do that is by using your wealth to do something better than just, build your nest egg. So boring investors invest in the unseen realm where there's apparently no return on investment. I would point you to William Wilberforce. If you don't know the name, I'd write it down. He's one of the most influential, impactful people in world history. And he didn't live that long ago. My kids hate when I say that, because he lived from 1759 to 1835, I believe. And he almost single-handedly with his friends, reversed the entire Western Hemisphere's view of slavery. And the reason slavery was ended in England and then other countries eventually was because of his efforts. He was very wealthy when he started. He was healthy generally when he started. When he was done, he was sick, he was tired, he was almost broke, but he had given his life to a very worthy cause. And hundreds of millions, if not billions of people should be thankful to William Wilberforce. That's the way I want to live. William Wilberforce invested as a boring investor. He invested for a testimony, not a title. And don't have time to go into all of what that means, but you can ask about it later if you like. Boring investors also invest to leave a legacy. And what I want to propose to you is that if you're a boring investor who wants to leave a legacy, find something you're really passionate about, even before you have a lot of money. When I sold my company in October 1997, I woke up the next morning with a couple $1 million in my bank account. For a 33-year-old, that was pretty amazing. But I didn't feel any more successful. Wasn't any more excited, about life than I was the day before. Like I said, the $95,000 rule, right? I didn't know that at the time. But since then, I have found something I really am excited about investing in. And again, investing to leave a legacy for me means finding a cause worthwhile and investing in it. I mentioned William Wilberforce. Well, Wellings Capital, my company, is working on a plan to set 5,000 slaves free in the next 5 years. And that's trafficked slaves. Did you know if you took the record, not the average profits, the record profits of Apple, General Motors, Nike, and Starbucks, rolled those record profits together and doubled that number, that's the projected annual profits from human trafficking. It's a massive problem. And I'd like to believe if I was alive in the 1800s, I would have been fighting against slavery, or if I was an adult in the 1960s, I would have been fighting for for civil rights. Well, this is a civil right. This is slavery, and it's happening right under our noses. In fact, several hundred people have been captured or sold into slavery since we started this webinar. It's many hundreds of people. And so it's a big deal, and it's happening right under our nose. So I want to end this talk about being a boring investor by encouraging you to find your big why, whatever that is, and go start to get involved now. Don't wait till you are on easy street or retired or you've got that wealth, that nest egg. Get involved now. I think you'll be happier that you did. And I think that you will be able to be maybe a little more boring than the person driving the fancy car, the Maserati, and living in the mansion, but you will be so happy in the long run, I predict. So that's the end of my comments about how to be a boring investor.
Paul, thank you so much. I'm going to jump in now. If anybody has any questions, just feel free to put them in the Q&A and I'll read them to Paul. I also want to thank you for the amazing presentation. And I wanted to ask you one question on where we talk about the difference between speculating and investment. And I know from reading your chapter in your book, you really deep dive into the differences. Can we just get a high level difference of what you define? And I kind of know the answer, but I would love to share it with the group. The difference between a speculative deal and an actual investment. And can you give an example of each?
Yes. So I am working on a book tentatively called Warren Buffett's Rules for Real Estate Investors. And Buffett had a wealth of wisdom at a very young age. And he realized that investing and speculating were quite different. Investing is when your principal is generally safe and you've got a chance to make a return. Speculating is when your principal is not at all safe and you've got a chance to make a return. Well, investing generally, although there are obvious exceptions, investing is definitely something it's generally something that's building wealth. It's in the process of creating cash flow, which I mentioned. True wealth is assets that produce cash flow. Speculation in general has no cash flow attached to it. Therefore, it has almost completely subjective value. And as a result, it can go up and down based on, a CEO scandal, or a war in the Middle East, or the tweet by Elon Musk about Bitcoin. These type of things are not true investments because they're valued, speculatively. Are they wrong? Absolutely not. I'm not even saying that. I'm saying, I have some speculative stuff, but I believe, and I think that, most of the greatest investors of all time believe that the best place to be is in an investment, is investing. So investing in a self-storage facility would look like, an investment, I should say, would look like, investing in a facility where the cash flow is $300,000 on day one. You go in and turn some knobs, add some marketing, kick out some bad tenants, fill up some vacant units, and you get the cash flow up to $400,000 a month. This is a real example in Grand Junction, Colorado. It actually started at $292,000 in annual net operating income. It went up to over $400,000. And so the value in commercial real estate is based on this incredible formula. The value equals the net operating income divided by the cap rate. So if you increase the NOI by, I actually don't remember what it was, I think it was 40% in this case, then you increase the value of the asset by 40%. And so that is an investment. A speculation, and again, I don't say they're all wrong, I'm just saying it's different. A speculation would be when I flushed, my friends and I flushed over $1 million to the bottom of a hole in the ground and hoped oil would come out. Well, hope's not a great business strategy. If it would have worked, I'd have been way wealthier than I am now. Seriously. But it didn't work and I lost that money. A speculation is when I gave this guy who said he would pay us 3% a month from this foreign exchange currency magic he was doing. This was 23 years ago in 1999, that he would actually be able to give us a huge return. And he or 2,000 other investors and I still don't know where he hid that money offshore when he went to jail for 158 years. He's 22 years into that jail sentence. But at any rate, that's a speculation.
And Paul, would you agree? So a lot of times newer investors would come up to me, and on our individual deals, we average, let's say 13 to like 15, 16 IRR. And I feel that's a good, safe investment, especially when half of it's coming from cash flow in the first couple of years. And then we'll get investors say, you know what, we were expecting 20, 22, 23. And then you try to educate them that a lot of times those are very speculative deals. They don't have the right financing in place. They don't have any cash flow whatsoever in the first couple of years. And then they really relying on a refi event of that, of let's say a bridge financing, which actually puts that principal in danger. So to me, when I hear 20 plus percent, I've gone on podcasts and say, you know what, I just X deals that come in at 20 plus IRRs, especially from newer operators, because those I label as speculative. But the Wellings Capitals and the other, some of the other operators that SIH Capital Group invests in as a limited partner, we look at those mid-teen IRRs and we say, you know what, the LTV, the loan to value, is very conservative. Usually we have agency debt on most of these deals from day one. They have huge portfolios. I think Wellings Income Fund 2, the fund that SIH Capital Group invests in, I think we're at 176 properties that we are getting exposure to. So it's well diversified. So to me, that I label as an investment. And sometimes it's hard to get that to newer investors or even seasoned investors not to be blinded by those higher returns. And they usually kind of venture to a developmental deal, and that like you said, you should do a lot of the investing and then eventually do some speculating. I would say, let's say 90-10, right? 90 investing and 10% speculating. But a lot of investors are blinded with those higher IRRs, are actually doing the opposite. They're speculating with 90% of their portfolio, and then they're investing with the other 10. And usually they get a bad taste from the speculation, and then they never really tweak out their portfolios.
Yeah, they go back to Wall Street's casinos and they give up.
Yeah, that's a great point. So I don't see any questions so far.
Hey,
So why
can
don't
I
we?
can I
Yes.
tell you something? I have never said this on a podcast before. It just kind of came to me in a different way. This is a quiz, and I don't expect anybody to get it right. If you do, Dennis, that would be amazing. One question quiz. Who's the largest real estate investor in the United States?
Is it the church or McDonald's? I forgot. It was I forgot one. They were like top two at one
Yeah.
point.
Yeah, you would think, wouldn't you? The largest real estate investor in the United States is, or I should say, are Fannie Mae and Freddie Mac. So who does better due diligence than Fannie Mae and Freddie Mac? I'm serious. I used to know the senior VP. I mean, I know the ex-senior VP, I should say, of Freddie Mac, Dave Stevens. He wrote a blurb on my previous book on apartment investing. And they're an incredible organization. Seriously, I mean, you think, oh, it's the government, they must be awful. No, they're not. They're not the government, really, and they're a quasi-government agency, I guess you could say. But they do a great job of doing due diligence. So if they put their stamp of approval and approve a loan for $10 million to Denis's apartment deal with SIH Capital, then it's probably something that has already been diligenced fairly well. Now you need to do your own due diligence. We have a 28-point checklist we recommend going over using Brian Burke's book, The Hands-Off Investor. That's a friend of Denis's. And we recommend going through that due diligence process still. But man, if you've got agency debt, that's a stamp, that's a thumbs up,
Yeah, 100%. That's such a great point. And Sam got it right. Sam, nice job. He actually said the U.S. government.
Yes.
So he got it right. I think
Close.
I should have gave him a chance to answer before I blurbed my answer.
Sam, I'll give you another question later. If I can think of one.
We did get another question from John. He said, as a passive investor, what are the 4 main issues to watch out for in a deal from a GP in multifamily? And I know you're more in self-storage and mobile home park, but you're definitely not a newbie when it comes to multifamily. So what do you think, Paul? What are the 4 main issues to watch out for in a deal?
A great operator can take a mediocre deal and sometimes make it great. A mediocre or a bad operator can ruin the best deal in the country. So my first main issue, and by far the main issue, would be the operator. Okay. So the operator, there's, like I said, 28 points of due diligence on them we might have, and that you can find that in Brian's book. I would say one of the pieces, and this would be my point 2 of the 4, would be the operator's skin in the game. Because when an operator has their own money in a deal, it's somehow, the decisions somehow affect them differently than if they didn't have their own money in the deal. So that'd be number 2. Number 3, I don't have like 3 and 4 like necessarily picked out. I have like 10 things floating in my head, but I'll choose one. Great property management. I'll say it a different way, I guess. Great property managers can pull a mediocre deal up to a good deal and they can also ruin a great deal if they're a bad property manager. So that's number 3. Number 4, I'm going to say, although I don't think this is an absolute maybe, and that would be geography. You can have the best deal in a sinking market in over 10 years. If the population is leaving, it's going to be very hard to drive increased rents and profitability. Or you can have a mediocre deal in a very, very fast expanding market like Austin or Charlotte or Greenville or Florida. And you can have, it can turn, that market can drive a great deal out of something that seems pretty average on paper. So there you go.
And John actually asked a follow-up and self-storage. So I guess, what are the 4 main issues? Yeah. Any of them different? I'm assuming 1 and 2.
Oh yeah, let's just do some different ones.
Okay, let's do it.
So yeah, 1 and 2 are the same, sure. But let's just come up with 4 other ones. Number 1, in self-storage, you want to check the software. I'm going to be a little deep dive here, called Radius Plus. Radius Plus is an online app or software, and it actually allows you to check the square footage of storage in a radius compared to the number of people. And you want to be in a radius where there is something like 6, 7, 8 square feet per person in that radius. So if you're in 100, let's say a 3-mile radius with 100,000 people, if it has 6 or 7 or 800,000 square feet of self-storage, that's about at balance. That's really kind of just average nationally. If it has less than that, all the better. So if you find a place that has, 100,000 people or 10,000 people, and it has 2 square feet of self-storage per person, even if it's a small town like Beeville, Texas, where we had a huge, wonderful investment there because of this ratio, it can work out. So that radius is number one. Number two, you want to be on a main road. You want to be on a road with, 10, 20, 30, 40,000 vehicles per day passing by. Number three, this may seem obvious, but you want to be very visible on that main road. There's a self-storage facility near me that I didn't even see for years, even though I passed it all the time. It's just kind of hidden back behind some other buildings. And number four, you want to be in a medium to high income area. You don't have to be in a really wealthy area, but you want to be at least in a medium to high income area. You definitely don't want to be in a slum. The worst deal we ever did in self-storage happened to be right in the middle of where some riots broke out 7 months after we invested. Literally, some of the riots that happened in 2019 happened right there at this facility almost. And so it turned it from a great deal into a terrible deal.
Was this Baltimore?
So, no, unfortunately, it was St. Paul, Minnesota.
Oh, okay. Gotcha.
Yeah.
And I just wanted to add, when you were talking about the multifamily, the 4 keys in multifamily, I think number 3 you mentioned is property management. I'll just add on to that is one of our due diligence on SIH Capital Group is the property manager and the operator, do they have a pre-existing relationship? It's maybe not as significant if the operator has a significant foothold in that geographic area, but the last thing you want as an investor is to have an operator in a new geographic area and at the same time with a new property manager. It's a recipe for disaster, because what's going to happen is if in 6 months or 12 months, if that deal is underperforming, the first thing they're going to do is fire that property management, and it will set back that business plan by 2 to 3 years easily. And it happens every time.
That's great, Dennis. I love that. Thank you for sharing it.
Yeah. And so John has another question. This is a little bit more broad, high level. It's a great question though, especially from a limited partner's perspective. He said, since I'm not a lawyer, what is the best resource to comb through a PPM and operating agreement, as it's a weakness for me personally?
Yeah, I've never done this before on a podcast, but I'm just going to be very direct. Oh no, I got another idea. Okay. I got 3 ideas. Okay. So here's 3 answers. Number 1, you can hire an attorney, and I'm just going to go ahead and give you the name. Is that okay, Dennis?
Yeah, absolutely. And you're not recommending, again, this is not you giving legal advice. This is you just saying.
Would I do that?
Exactly.
No, seriously, Larry Pino, Pino. He's near Orlando, Florida. He's, he can check out a PPM and do a very, very, very deep dive and give you all these points of, ask him this, ask him that. That's one. Or you can do a lighter dive and charge you less. But Larry Pino is a great guy. I just got to know him since October, so it's not like I have any pre-existing relationship until the last 3 months. Number 2, you can go to I don't really know these guys. I think they're in the Carolinas, the 506 group. Dennis, you might have heard of them. It's a large group of investors, and they give honest commentary, and they actually critique deals, critique operators, critique PPMs. There's a more famous one called, and this is my third answer, the Real Estate Crowdfunding Review. Most of us have heard of that. The Real Estate Crowdfunding Review, headed up by the tech genius Ian Ippolito, has thousands and thousands of reviews on operators, deals, PPMs, outcomes, all kinds of stuff. And then I just remembered a fourth one, Left Field Investors, Jim Pfeiffer. We know him from Bigger Pockets. Left Field Investors also has similar sharing from what I've heard. Now it's interesting, Dennis and I as operators can't get into those sites. I have never been inside those websites because I can't. I mean, without, giving myself a fake name and lying, I can't go in there because as an operator, we're not allowed to see what people say.
Yeah, and I second that. Even though, like, I try to get into those from an LP perspective because we do LP deals as well, and they would not let me in at all. I'd also throw out Jeremy Roll in the Roll investment group. He's very similar. If you're in his investment group, he gives very honest feedback, and when it comes to reading a PPM, he is absolutely excellent.
He's in a class by himself reading PPMs.
And I'll also throw out some other pointers. I would say one is when you read it, does the language seem fair? The PPM should protect the investor as much as the operator. Like, you don't want it to be, it shouldn't be skewed in favor of the operator where, the investor really doesn't have any, potential recourse, but you also don't want to be in a situation where one unhappy investor could cause a lot of problems. So if you read the PPM and does it seem fair, I think that's important. Second, I'll second on Paul Moore when he says, send it to an attorney. Make sure you send it to a securities attorney.
Yeah.
Because a securities attorney is its own, it's its own animal, I would say. And what happens is if you send a regular PPM and OA to a regular business attorney, they'll take a look at it and they'll say, oh, this looks good, or whatever it is. Especially from an operator, if you're ever going to do a joint venture or anything like that, if you have a conversation with a business attorney and you say, is this legal? They'll say, oh, absolutely, this is legal. You take that same exact conversation, same exact document, and bring it to a securities attorney, 9 out of 10 saying, no, that you've created a security. And so you really need someone that knows the inside and out of a securities. So what Paul is saying is great. Reach out to a securities attorney, and maybe for an hour of their time, it won't be that expensive to you, especially if you're considering a $50,000 investment. And then you really need one PPM checkup, because what happens is most operators will use the same securities attorney. So once you see one operating agreement and one PPM from that, like if I saw Paul Moore's, Wellings Income Fund 2, if I see Wellings Income Fund 3, there might be a couple of little changes, but it's the template, the bone structures is all there. So you might only need to, if you're going to invest three, 4, 5 times with a specific operator, you might only need one consulting hour with a securities attorney. So it's a worthwhile investment to do so. And the last thing I would say on this topic is it's really important of who is the SEC attorney behind that PPM. Sometimes just if you Google them, SEC, issues and that specific attorney's name, you'll come up with if they're under any investigation or anything like that. And usually that's a pretty bad sign if the attorney behind the PPM is being investigated for whatever reason. You want that clean slate. And honestly, that could just be a Google search, and that will come up. So those are a couple of pointers I'll throw out there to other limited partners when it comes to PPM. I don't know, Paul, you have anything else to add to that?
No, that's good. That's really good.
Okay. I don't see any other questions, but Paul, I know we were going to talk into self-storage. I don't think we have enough time because I know we got to cut this a couple of minutes before 8, so your wife's not mad at you. What I want
to go eat a boring meal with my boring family.
Yeah, hopefully you don't use that language on the dinner table.
No, they won't get it, but I mean, you get it. Everybody on here gets it. So this is some of the advantages of self-storage. So
if you want to, maybe the 3 key points, and then I really want you to maybe pull up again your book and where people can find your book, so we can kind of steer them to that direction.
Great. Yeah, 3 key points. Number 1, self-storage is recession resistant and strengthened in booms. Nobody ever knew what a COVID or what a pandemic would do to self-storage versus other asset types. But COVID has proven, self-storage, Wall Street Journal, Business Wire, and New York Times have all done recent articles explaining how self-storage has just pulled away from the other asset types during and since COVID. And there's so many reasons for that. I can explain them if we had time, but it's just going very, very well. Think about it. In bad times, you've got the 4 Ds. You've got death, downsizing, dislocation, and divorce. And we hate all those things. But during those times, people are often in transition and they're often needing a place to store their stuff. In great times, people are filling up their Walmart and their Amazon carts with more stuff, and they need a place to store some of it. And and that brings me to my second point, and that is that prices are inelastic. What that means is, look, if I'm renting $1,000 apartment, or maybe in your area, Dennis, a 2,000, no, anyway, you get the idea, $1,000 apartment, and the landlord raises the rent by 6% for a year, I might think, I don't know if I want to pay 60 extra bucks a month. That's $720 a year to live here. I might just move. But if my self-storage operator raises the rent by 6%, and I'm paying $100 a month, I'm probably not going to spend a weekend, gather a U-Haul, gather my friends, take all my junk, my treasures down the street just to save $6 a month. I'm not going to do it, especially with a month-to-month lease. And I'm thinking, I only need it 2 more months anyway. As soon as I can get a few days off, I'm going to clear that out, which is what so many people think. Well, they don't often do that. So they're not price sensitive. In fact, and that brings me to my last point, and that's the last point on this slide, though there's so many other good ones. It's the best inflation catcher I know of in commercial real estate. Think about it. I know a guy in New Hampshire who leases Amazon warehouses. Well, he's got that 20-year lease already set up. If inflation goes through the roof, he won't capture that because Amazon's got a fixed lease for 20 years. An office building, similar. A factory or warehouse, similar. But self-storage, we can move the rents up monthly, and some people do. And so it's a really good way to catch inflation. Can I give you one fourth point here?
Yeah, go ahead.
We wrap? My favorite point is the opportunity actually to buy from mom and pop sellers. Mom and pop sellers are great. There are 53,000 self-storage facilities in the US. That's about the same as Subway, McDonald's, and Starbucks combined, but about half of them are owned by mom and pops. And here's what that means. It means that they typically, I should say, don't have the desire or the knowledge or the resources to increase income and maximize value. Look at this graphic here. 93% of multifamily are already, they're owned by our operators that have the means to do the value adds. But self-storage, only about 24% of the operators are in that category. 76% are independent operators. Now, that doesn't mean they're not doing value add. Many, many of them are. But literally about half of the self-storage operators, that's about 50%, are mom and pops that have one facility, and they typically don't do the upgrades. I literally talked to a self-storage facility in my own town the other day, just happened to talk to them. They said, yeah, we raised the rent. We raised it 4 times in 28 years. What? Yep. He said, we're full and we're happy. Well, that's great. That's a great target to buy a facility like that, let me tell you. So yeah, that's all I got.
So I did, because I know one of my investors sent us a question beforehand, and I just want to make sure I get it in.
Yeah.
He said, and I think this is coming from my book, I think there was a statistic when I wrote the self-storage chapter, was that in the last 3 years, there's been more new development in self-storage than in the last 50 or so. And a lot of people on this call probably know you can't go down a route, without seeing a self-storage place. So the question is, I'm curious to get Paul's outlook on self-storage space, particularly on supply and demand. It seems that the demand is stronger than ever. Some people are downsized and dealing with transitions. Some are trying to make additional space in their homes due to COVID. But I'm also hearing about a good amount of supply coming to the market. Does this additional supply give you concerns about competition?
Absolutely. In fact, our almost worst self-storage deal was when some national competitors popped up right down the road when we were just opening our doors to a new big section of this facility. I can take it in Nashville, though. Dennis, I can show you, I can drive you all around the city and show you how terribly overbuilt it is for self-storage. Terrible. But I can also take you south of Nashville to these beautiful high-end suburbs of Bellevue and Belmont and show you how terribly underbuilt they are. And then again, I would use that Radius software and I'd say, look, this is why you need to have a professional operator who knows what they're doing to find an area that is underdeveloped. My friend AJ Osborne took a Reno, Nevada super Kmart. He bought it and he sold off the parking lot to apartment developers, and he cut it in half and he made it into a beautiful self-storage facility. He had $2.5 million in cash in it, 5 million in debt, so 7.5 million total. I was on the phone with him and he got an offer of $26 million for this facility, and it wasn't even nearly full yet. But it was in an underserved area, and that's what we really need. But yes, that's a great question.
And I think that highlights why sometimes investing in a fund pays off versus investing in one individual deal. Because when you get these offerings, they all look really, really pretty, and that's their job. But you need the operator. Like I know Paul, and I try to emulate Paul on certain things by going and meeting the mobile home park operator and seeing the area that they're in, or the self-storage, like actually physically going out there beyond, taking it the step beyond the actual, the just seeing it on the offering. I remember one great piece of advice that Jeremy Roll gave me in one of our conversations was, if you just physically went to some of these, and we were talking about ATM machines at the time, and he said, if you physically just went to some of these ATM machines, you would have been able to catch about half the Ponzi schemes that are out there, because it's taking that one step beyond just getting that investor presentation. And that's why when we did the deal in Pennsylvania, we were excited. We opened the door. When we went to the due diligence, we opened the door. 8 investors actually came out. That's kind of the advantage of actually being able to invest in your backyard. And the last thing I wanted to mention, I know we have like a minute left, but just to highlight your book, Ken asked, Paul, you wrote a book about multifamily and you wrote a book about self-storage. Do you prefer self-storage over multifamily? And I guess we'll throw in mobile home parks, because I kind of know the breakdown of your portfolio, but just for people to throw out those 3 different asset classes, where would you rank them right now?
Well, how can I ever rank anything above the perfect investment? I will, though. Self-storage and mobile home parks blow away most of the multifamily deals I've seen in the last 4 years. Now we actually just invested in a multifamily. I love multifamily. I think I always will. And if you had to pick an asset class that if I had to make an investment and let it sit for 100 years, I would invest in apartments, because I don't know how people are going to be storing their stuff in 100 years. But I like self-storage and mobile home parks because of the meat on the bone of the value, the mom and pops that are leaving so much value for a professional operator to come in and improve on.
Okay, perfect. And I think we'll stop here. Again, you can find his book on Amazon. That's where I bought it. I think you could also get it on Bigger Pockets. Usually Bigger Pockets does bundles.
Yeah, biggerpockets.com/storage.
Storage. I highly recommend it. It's a quick read. It's only 200 pages. I always talk that when I created my book, the point was to give 20, 30 pages. And if you like that asset class, to go find other books that specialize in this. So this is a perfect example. If you read my book and you read the chapter on self-storage, like Paul Moore's book is that next step you would take if you want to do a deep dive into self-storage, or if you hear on him on a webinars and podcasts. And I think we're probably going to do a subsequent webinar where we're just going to do a deep dive on self-storage and maybe throw in some mobile home parks, because that was supposed to be kind of part 2 of this, but we had some great questions. I'm glad we got to go over them. So we'll end it here. I'm so thankful that everybody that came out. I'll be sending out the webinar replay. Make sure you go on Wellings Capital if you're interested in potentially investing with their email list. Paul sends out some great articles. I even featured one of his articles on my website, because he does send out some really great educational stuff. So we're not always just trying to get investors. We're trying to educate so that we attract the right investors to our individual brands. So again, Denis Shapiro, SIH Capital Group. If you're interested in my book, The Alternative Investment Almanac, you'll find it on Amazon. Paul Moore, Wellings Capital. Make sure you visit his site if you're interested in joining his email list. And don't forget to pick up a copy of his book. Thank you, guys.
Thank you.